Morning, everyone. Morning. Thank you for attending today's presentation. Maybe just some general house rules. If I could please ask everybody to turn their cell phones off. Also, we have applied for CPD sessions for today's session, so please just remember to scan yourself out as you exit the venue. You guys will also receive an email with today's event collateral and also an SMS with a link to a feedback form, which we would really appreciate you guys completing. We always try and improve on these events, and those forms obviously help for that. Welcome to the PSG Winter Update, in which we look at global and local equity markets, just unpack that a little bit in terms of the way that we see those markets. I am Marius Havenga, one of the fund specialists for PSG Asset Management. Now, this has been an incredibly tough year so far for global markets. There's a lot of fear and uncertainty around the world, and a lot to be worried about, justifiably so. So we've seen very high inflation prints across the globe, and those high inflation numbers have led to higher interest rates. Now, those interest rates in turn have then led to recessionary fears across the globe, both in Europe but also in the US. Let me just get to this next slide. In Europe, we're also seeing a massive energy crisis, load shedding, which I think we often think is a uniquely South African experience, might soon be coming to some of those European countries. Locally, we also not spared from any of this negativity and issues. In South Africa, we've got our own very high levels of load shedding, and along with that, political unrest or political escapades, let's rather say that, as well as some labor action. All of this combined definitely does not help investor sentiment. So PSG Asset Management has a track record of delivering excellent returns for our clients during these periods of heightened fear and uncertainty, and this time is no different. We continue to employ our 3M process, and this process has allowed us to uncover very attractively priced assets, and also means that our buy lists are currently full. I'm joined today by two of our senior fund managers, Shaun Roux and Philipp Wörz. They will take you guys through the local and global landscape. Firstly, we're going to have Shaun Roux on. He is the manager of the PSG Flexible as well as the PSG Equity Fund. Shaun, over to you. Thank you.
Good morning, everyone. Thank you for joining us in person. It's really nice to connect face to face, and also thanks to the people who will take the time to connect online via the webinar. There you can see my ugly face. My colleagues have started referring to me as a veteran of the industry, which is a term I'm not sure I like, but I'm going to have to live with. I've been responsible for the equity fund for 20 years now. So we've seen a few cycles, and we're looking at another one of those challenging periods where your clients are giving you a hard time, and I'm sure they're pushing you to run to cash and get out of risky asset class like equities. And what we're going to spend some time doing today is actually trying to convince you that that's not necessarily appropriate, but also, and probably more importantly, it's all about which equities you're in. And the overall message from PSG Asset Management is we're actually extremely bullish right now, but we think you need to be managing money in a particular way to be bullish about the markets. And if you manage money the way we do, to be extremely bullish about the markets. What we prefer to do in times of such significant gloom and uncertainty and fear is to take a bit of a step out, and we think that serves you very well right now. And what we want to talk about is the benefit that can be derived by taking a bigger picture view of what's been going on in the markets the last 10 or 20 years and trying to understand the implications for future asset class returns. And the phrase Philipp and I have coined is this concept of the big unwind. We think there have been very significant market distortions and in some cases it's been for in excess of a decade. And we think that a big part of the investing public is actually not thinking properly about what that unwind looks like and what it means for asset class returns in the future. And this is going to be where we're going to focus today. The headlines that your clients, yourselves, and ourselves are reading are unequivocally gloomy right now. If it isn't Nancy Pelosi heading off to Taiwan, it's inflation, and the new term is consumer pressure. It's a consensus within financial markets right now that we're on the cusp of a global recession. People are starting to talk about stagflation. The first 6 months of this year, we saw the worst performance from global equity markets in more than 50 years, using the MSCI World as the benchmark here. So it's been tough. And when conditions are this tough, what you'd expect is bearish sentiment to rise. And it's interesting to note that global fund managers are the most pessimistic they've been since the midst of the GFC. The cash levels are the highest and equity levels the lowest since April 2009. So that fear has pervaded positioning, and we have a track record of exploiting those kind of conditions to our clients' benefit, and we think right now provides just such an opportunity. And if I do that zoom out of the current fears into the things that we think are going to really matter in the years ahead, what we're turning our eyes to is 5 market distortions, each of which we think are very significant in size and have had a very big bearing on past asset price returns and in particular future asset price returns. And the distortions that I refer to, the first one is cheap money. Money's effectively been free in recent years. And when money is free and negative in real terms, in other words, after inflation, what it does is it incentivizes people to take risk in certain areas, and it drives up the prices of certain assets, and we're going to talk a little bit about what that means. We've also had a massive charge into passive investing. Passive investing has its place in the investment industry, but one of the functions of passive investing is that the money tends to get allocated to the winners of the past at the expense of the recent losers on a price performance terms. The other really big thing in investment markets in the last 2 years has been ESG. And ESG has had a significant impact on asset prices. It's an investment theme that is conjured up with the best of intentions, but it's had what we think there's significant unintended consequences that have come to bear. And what ESG does is ESG investors or an ESG mandate decides which are the good industries that require investment and then are appropriate to invest in. And it encourages you to not invest or preferably divest from bad industries. And that's had a very big impact on financial markets. On the local front, we've had many years of capital flight. Foreigners have been fleeing from emerging markets for a number of years. South Africa has been underweighted within the emerging market complex. So South Africa is very under-owned by foreigners. Where have they been going? They've been going towards places like the US and emerging markets that are more in vogue, and particularly emerging markets that have high exposure to something like technology. We've also had local investors continuing to cycle their money offshore, ostensibly for the right reasons to diversify, but in recent times that's been more a case of a panic. And in the midst of 2020, I think we saw an outright panic with respect to local assets. And when you see significant capital flight, it has a big impact on asset prices, and I'm going to show you later what that means in terms of the opportunities that are available domestically currently. And then the final factor, the final distortion, is fiscal stimulus. And what we know is that fiscal intervention by government is the best way to stimulate the real economy. Quantitative easing by a central bank has very questionable effectiveness, but fiscal works. But normally when a government does fiscal, it does it it applies capital to the productive elements of an economy. It builds bridges and roads and ports and railways, and that's a fantastic form of investment. The fiscal, and if we're talking somewhere like the US, we're talking $5 trillion of fiscal since the pandemic started. This time around, the fiscal has taken place in the form of checks. They've been handing out checks, which people have either chosen to save or to spend, which has had a big impact on some of the inflationary numbers we're currently seeing. But if I step back and I look at those five elements that are distorting markets, the important thing is, what does it mean? What we think it means is that people have been incentivized to take risk in certain areas. That very cheap capital has implied that the asset classes that are beneficiaries of very low discount rates have been very much in demand. When you have that combination of rising prices together with a lot of liquidity, you're always going to get speculative behavior. And 2020, 2021, we saw some very clear examples of speculative behavior and what we would actually call them bubbles in certain parts of the market. The other overwhelming factor that we've observed in the context of passive ESG and cheap money is a misallocation of capital. So the capital has been going to the areas where prices have been rising, and it's been going to the good industries. And if money or investment is not going to the perceived bad industries, prices are depressed, but more importantly, you end up with some of the scarcity and shortages that we're seeing today, whether it's in supply chains or right across the energy complex or in raw materials. There just hasn't been enough investment, and it has a very, very big impact on not only asset class returns, but in terms of the prices that one can expect to pay for energy or copper or ammonia, etc., in the future. And the overriding feature of this backdrop, which gets a company like PSG excited, and the reason that we're bullish, is the key feature is these massive differences in valuations. So the winners of the past, what everyone loves, are expensive and remain expensive. And the parts of the market where there's been this underinvestment, where capital hasn't been allocated, that part of the market is really cheap. And for differentiated stock pickers, it's a very, very good environment to be building portfolios for your clients. If you're invested in the winners of the past that required negative real rates or cheap money or the existing conditions to persist, it's going to be a tough time. Particularly if we start talking things like, the Fed raising rates or potential global recessions. So how are you going to go about growing capital for your client in the future? We think it's actually a very good environment for growing capital, but we think you're going to have to need to be differentiated. We think you're going to have to be able to think differently. Importantly, you're going to have to be able to look through some of these short-term fears. Instead of spending your time, trying to speculate on whether the US goes into recession in the fourth quarter of 2022 or early 2023, look into where the returns are going to be made, but you're going to have to take a long-term view. We think you've got to look wider than that cohort of asset classes and stocks that worked over the past decade, the US, tech, growth, etc. We think if you can look wider into other geographies and other investment opportunities, it looks really, really exciting. There's been a recent obsession with quality, and we think there's been a very narrow definition applied to what is quality. We've got a process that looks a bit different, that comes to a different conclusion in terms of what quality is. And it actually looks very favorable for exploiting a slightly different interpretation of quality. But most importantly, it's always going to be about price. And people have lost sight of it, lost sight of the fact that if you're buying an asset for a good price, you're likely to get better returns than the other way around. And those distortions I spoke about, we think have masked the importance of price in terms of long-term returns. Our process, which our investors would be very familiar with by now, I hope, is our 3M process. This is our guiding light. It keeps us honest. It gets us into the right areas, whether we're investing globally or locally. It's our moats, it's our management, and our margin of safety. And what we try to do by looking at every stock through that lens is we trying to find inherent quality that the market is missing. We're trying to pay a good price, and we're trying to take a long-term view. And the obvious question is, okay, that's all very well, but how do you find quality in this market? And what PSG tends to try and find is this concept of underappreciated quality, quality that the market is missing. And we think there's a lot of that around at the moment. So how does a business, how does quality become underappreciated? It's underappreciated where the ability for a company to grow its profits long into the future is masked by something that's happening at the time. Whether it's COVID and a very big spike in paying out your life insurance claims, which you can see we own a few life insurers across our funds. That's certainly been the case. Or in particular, if you're going through an investment phase and you're currently investing in your company and your profits are being suppressed, but that's going to give rise to higher profits in the future and get you onto a nice growth runway. There's some good examples here. Remgro's been investing its fiber business in South Africa. There's billions of rand going into that. Those profits are only going to be experienced 5 years down the line. Discovery is investing in a bank. It's investing in a global platform. Those costs are going through the income statement. They're currently suppressing profits. So if business like ours can look 5 years down the line, knows that profits are going to be significantly higher, but the market's currently obsessed with who's growing profits right now. And what that does is it creates a very low base from a valuation perspective. So we can buy these companies very cheaply, and you'll see them featured across all of our portfolios in relatively large size. The other area that's getting us really excited at the moment is more cyclical companies. And these would include both financial companies and commodity-related companies. The financial companies are pretty easy. Valuations are really, really depressed, and earnings are really low. And we own South Africa insurers and banks. We own we own Japanese financials. We own UK financials. It's a very, very a rich place to find opportunities for us right now. But we also own much more, we also have much higher exposure to commodities than what you can typically expect from PSG portfolios. And the reason for that is pretty simple, is that despite the recessionary fears, what we are choosing to do is we are choosing to look into the structural backdrop for many of these commodity markets, and in particular, focus our research on the supply side, or in other words, how much investment has gone in. And if you observe, like we are currently observing in a number of commodities where there's been significant underinvestment, what that means is there's going to be insufficient supply for a number of years to meet demand, and prices are going to stay high. And when prices stay high, cash flows are high, and shareholders enjoy significant returns. This is a topic we'll delve into in a little bit more detail. But just starting with a case study on investing in commodities and commodity-related, I've chosen to use Glencore, which is a significant PSG investment, as an example of what we've been through in commodity markets, and in particular to focus on this concept of underinvestment in supply. And what I show you here is I show you capital expenditure by the 6 big global miners. And you'll see this has been very much a boom-bust story. So we had the Chinese super cycle. What we saw is we saw the miners rush to build mines. That mine building peaked in 2012, a point where these 6 miners were spending in excess of $70 billion a year on expanding capacity. Glencore chose to list at that time, which was good timing from their perspective. And then we had an almighty bust and a near-death experience for a company like this, which the worst of that was early 2016, and late 2015, Glencore had to actually do a capital raise. But the important thing that we've seen ever since 2012 is when Glencore has engaged with their institutional shareholders have said to them, you are not going out there and building mines. What you are doing is you are first paying down debt, and then you are paying us dividends, and you're doing share buybacks. And every single one of the mining companies has adopted significant capital discipline in recent years. They're not out there building mines. We overlay the ESG movement, which has put significant pressure on extractive industries to stop building mines or drilling wells, etc. And we've seen significant underinvestment in a number of metals. And looking on this basis, the current levels of investment spend are less than half what they were in the peak of 2012 and far too light to meet what we think looks like future demand. But the anomaly is that against this backdrop, a company like Glencore today trades on 4 times cash earnings. So it's cheap. And it's returning just about all of that cash to shareholders currently, the free cash. So we're getting 21% returns currently in the form of share buybacks and dividends. Yes, within that, coal profits are high, and many are arguing that coal profits are unsustainably high. We think coal prices probably are too high, but they're going to stay relatively high for a number of years because in the context of that energy complex and the underinvestment and divestment that's taken place, coal becomes the arbitrage. Coal is the power station that can be quickly fired up to meet deficiencies in other areas. And because those deficiencies are so significant, coal's got a role to play for many years into the future, which incidentally is not a bearish scenario for South Africa. Turning to South Africa, one of the questions that Philipp and I have been asked a lot in recent weeks on our roadshow is, why have South African assets done well in 2022? This has been a very tough environment, and South Africa normally does poorly when markets become fearful. But many South African assets are actually positive year to date. And I think this chart captures the backdrop for asset pricing in South Africa relative to other parts of the world. And what I show you here is I show you real yields. So I take 10-year bond yields, and I subtract medium-term inflation expectations. And what you will see is that in somewhere like the US and Germany, real yields have been, for the last 20 years, have been coming down, 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 to the extent that they went negative in Germany in 2015 and negative in the US in 2020. And what you see recently is these real yields starting to turn up with the Fed starting to hike interest rates. And we've all seen the impact that that has had on financial markets. We contrast that with South Africa, and we see that real yields have been pretty high and continue to rise. This reflects directly in domestic asset prices and indicates that South African asset prices have a significant cushion built into them. And another way of thinking about that is expectations are incredibly low. And even if our economy continues to muddle through, those low expectations are met, South African assets will do just fine. And if those expectations, those very low expectations, are moderately exceeded, South African assets are going to surprise many, many people. And taking that opportunity set and taking it a bit deeper, we think there's a standout opportunity within the local investment landscape. So South African assets are very cheap, and then we overlay the liquidity risk premium that's attached to South African mid and small caps. And what you're seeing is a fantastic opportunity for people that are prepared to pick stocks and are prepared to take a longer term view. And what I show you here is I just show you PSG's 8 largest mid-cap holdings. And I show you how they've done over the last 18 months. In other words, from the end of 2020 through to June of this year. And some of them have actually done pretty well. And that's despite a pretty gloomy South African economy. And if you look into the specifics of why have they done well, they've done well because we think our clients are invested in a cohort of stocks that don't require a booming economy, that are high quality businesses with good management teams, most importantly, have just been super cheap. And they remain incredibly cheap. So to give you a sense, a company like Hudayco is currently reaching record profit levels despite the gloomy economy. It trades on 8 times earnings and at record profit margins. Supergroup, which is about to report its earnings imminently, and those earnings are due to rise 30 to 40% year on year, trades on 7 times those earnings. So we're looking at stocks that are typically trading between 5 and 8 times earnings. Sun International is still not out of COVID. We think 2023 cash profits out of Sun International in a first time they've had a normal year since 2019, they're going to be on 5 times those profits. So this feels to us like a very fertile opportunity set to exploit on behalf of our clients. We own at least 5% of each of these companies. We've been buying these companies in the tough times. You'll see some of the companies have not performed particularly well over the last 18 months. We think they still owe us. There's no fundamental reason that they shouldn't deliver the kind of returns an HCI or Sun International or Hudayco have over the last 18 months. And in particular, I reference the JSE. JSE loves volatility, loves fear. Its numbers yesterday were excellent. It's on an 8% dividend yield. Roux is going to have a fantastic opportunity in the renewable power build that is going to be of massive scale, and it's coming. So we're very bullish this particular area. What I'm going to do now is I'm going to pause and I'm going to hand over to Philipp. He's going to delve a little bit deeper into the global opportunity set, and then I'll come back and bring it back home to our local portfolios.
Great. I'd like to echo Marius and Shaun and thank you for joining us today. Now, obviously, looking at me and Shaun, it's clear I'm not a veteran of the industry, but I've been at PSG for 15 years and I manage on the global funds for the past 7 years. Now, for the next 20 minutes, I'm going to take you through our global opportunity. I'm going to discuss our global capability and track record and delve deeper into how distortions are giving us great opportunities globally. Then I'll discuss the need for differentiation in global markets currently. And lastly, finish off with our global positioning and hopefully show you that despite the fears on the market, we're bullish on our global opportunity set. I think, as you all know, there's been a lot of kind of debates in the financial press recently, mostly emotive, whether South African managers are equipped to manage global assets. Now, our stance on this topic is pretty obvious. But I think you will all agree with me that getting global right is no longer a luxury, but a necessity in the South African asset management context. At PSG, we're actually one of the earlier asset management houses to invest in global assets. We started investing globally in 2008. We've got one globally integrated investment process that looks at both global and local through the same lens. And we think that gets us into the right areas globally. Now, that's a competitive advantage in our view, as it takes a long time to build experience, also to unfortunately pay a lot of school fees along the way, to then build a robust process that can compete globally. In our view, our global track record has been a strong contributor to our domestic franchise. And also with the increase of the offshore limit recently to 45%, and the fact that the JSE is quite a small market, we think global will play an even larger role going forward. Market distortions, like cheap capital, like passive, have given rise to a large misallocation of capital, in our view, that's resulted in money flowing into new economy type areas at the expense of old economy productive assets. On this chart here, you can see the S&P 500 index weights of sectors like energy and materials in purple and IT, telecoms, media in blue. Now the S&P, and it's very similar along the MSCI as well, global indices have become enormously skewed towards the winners of the past. Those mega cap tech platform companies like Apple, Microsoft, while underperformers over the last decade, like energy and materials, have seen the share of the index decline significantly. As you can see on the chart here, the IT stocks are at concentration levels that you last saw during the dot-com bubble, while at the end of June, materials and energy only accounted for about 7% of the index. Now, it's pretty natural for investors to extrapolate the past decade, but also given that the weighting is very low in materials and energy, it shouldn't be a surprise that most portfolios out there are full of tech, but people haven't had an incentive to really stick their necks out in energy and materials. Now, this kind of dynamic, in our view, creates significant mispricing and great opportunities. Now, as some of those distortions unwind, we do expect index compositions to normalize, which has a big result and implication for asset returns going forward. I touched on the debate earlier whether global can be done from South Africa. We believe we've actually demonstrated a good track record of getting into the right global areas, as evidenced by two very important calls in the last 6 to 7 years. As most of you know, we like to invest into uncrowded areas. And on this chart, you can see the sector weights of the PSG Global Equity Fund in the sectors of information technology and communication services. Back in 2015, 2016, when many of these stocks were pretty cheap, the likes of Microsoft and Apple, technology was actually the largest component of the PSG Global Equity Fund. Now, as prices and valuations rose in the subsequent years, we reduced our exposure to that space. Now, arguably, given what happened pre-COVID and with the melt-up in valuations, we were very early in exiting the tech sector. But what you also notice is that's the total mirror opposite of what you saw on the previous slide of what the index kind of is currently comprised of. Now, at PSG, we like to rotate and allocate capital away from high prices, high valuations, into areas where the market is giving us opportunities. And in this case, where the market was actually, or distortions were depressing asset prices. And one of those sectors was the materials and energy space. And you can see our allocation into materials and energy in recent years. Now, exiting tech, buying energy materials, obviously resulted in underperformance in 2018 to 2020, but it was a very important factor in the last few years to recover strongly. And it was also a driver for our global equity fund being in the first quartile in its global category over the last 3 years. Our local opportunity, our local performance, as I said, has been an important contributor to fund performance in the last decade. What we've done here, we've taken data from StatPro, which is a performance measurement tool, and basically mapped the performance of our global stocks that are in the PSG Equity Fund, our domestic fund, and compared it to the MSCI World Index. And as you can see in the chart here in the blue, we did very well until 2017 before rotating into cheaper areas at that time. And then you can see the outperformance in recent years. But what I want to show you, though, is the annual performance of the local carve-out or global carve-out in the local equity fund and compared to the MSCI World. And you can see in 2017, 18, 19, which was a time of maximum market distortions, how we underperformed. But as some of these distortions started unwinding in recent years, you can see the benefit of that coming through. Why I want to show you this is just to showcase that we think it's been a good contributor to performance in the past, and the way we see the market unfolding over time, we expect global to be critical for our domestic franchise going forward. Now, to grow capital over the long term, as Shaun discussed previously, it requires a long-term view, it requires differentiation, but it also requires an alternative take on what quality companies are. Now, these stocks here are companies that are in the top 10 of the MSCI World Quality Index. Now, in contrast to underappreciated quality companies, this is quite a narrow universe of past winners that would dominate most passive and active portfolios out there. Now, these are great companies, there's no denying that, but we think people have taken a view and the quality, the think about these companies is as a result of the price performance, but also critically, it's as a result of what the re-rating you saw in that space. The P/E ratio of these companies went from 14 times 10 years ago to 35 times at the end of last year. We think it actually made them pretty risky. Now, we've seen some kind of deflation in these stocks this year. They're down 20% on average. But when we compare them to our underappreciated quality companies, we don't yet see a margin of safety in the space. And I would also argue quite a few of them had a COVID bump and there are headwinds coming. But there doesn't seem to be a view that's kind of shared by the rest of the market. To ultimately what we try to do is understand, let's say these distortions that we're seeing start unwinding, but what we want to understand is the impact they will have as it happens. So what we did was we analyzed the global equity universe that's available in Morningstar, which are about 2,900 funds. That's $1.4 trillion of assets. And we try to see how the companies or how the funds are positioned. Now, Morningstar ranks global equity funds into 4 categories generally, one of them being large cap blend, which would be a general large cap equity fund. It has growth funds, it's got flex cap, which are funds that invest across all market caps, and then also value funds. I think no one sitting here is surprised to see that most money is obviously in your large cap general equity, but what's quite striking to us is 20% of these assets were sitting in growth funds, but only 5% sitting in value funds. Now, that kind of reminds us quite a bit of what you saw earlier in materials and energy. There's just no money invested into that part of the market. Now, that only tells you kind of a first level that obviously people prefer growth over value. That's kind of what's worked. But what we then tried to do is go one level deeper and understand how individual funds are positioned. Now, what we did, Morningstar's got quite a nifty tool called a holdings-based style map, which basically maps companies or funds rather along the size of companies they invest in, but also according to the investment style. And the investment styles they rank are ranging from deep value all the way to high growth. Now, out of the 400 largest funds here, none of them actually ranked in deep value, so that's why I left it out on this chart. But interestingly, only 10% of the number of funds were sitting in the core value category. That leaves 90% sitting in core and high growth and core growth. But what's interesting to us is, and I showed you the index composition earlier and the crowding into quality, that by implication, the index already has a growth and a quality bias. And you can see the MSCI World Index in the red dot over here. And you can see the clustering around the index, which is quite interesting to us. Now, what we've also done is put the PSG Global Equity Fund on there, and you would see it on the bottom left, showcasing that we invest across a wider set of market cap companies, but also we're sitting squarely in the core value camp. And we think that differentiation of our positioning will benefit clients well over the coming years. Now, 400 companies or 400 funds is quite a lot, so to make it a bit more topical for you and bring it closer to home, what we did is we did the same analysis on the global funds that are available for distribution in South Africa, about 40 key funds, and the results are pretty much the same. Most funds cluster around the index, deliberately or not, that's a different discussion. But given that we think the next 10 years will pan out different to the last, will have big implications for returns going forward. So the question we think you should be asking yourselves is, A, is the fund manager you paying active fees to an index tracker? And the second question is your fund manager positioned differently enough for the next 10 years to be different to the past? We think we know the answer to that. Now, one point, and it's a critical point, is one just shouldn't be standing up here and say you need to be different. You've got to be different for the right reasons. But when distortions that we are seeing are giving rise to these massive divergences in valuations, we are compelled to take advantage of those. And what this chart here shows you is the valuation difference between what's cheap and expensive in the US and Europe, and we are at levels as extreme as in the last 30 years. Now, with these divergences happening, we think that's just an excellent environment for differentiated stock pickers like ourselves to take advantage of, and that is a critical point. Conditions are pretty similar on the JSE, so once again, a really ripe environment for stock picking. One of the areas that's kind of leading to these divergences in valuations is ESG. Now, ESG's intentions are very noble, but they've also led to unintended consequences, which includes a significant misallocation of capital. Even The Economist, which has kind of been a cheerleader for ESG, seems to have given up on ESG in the current shape and form. In our view, the way ESG is being applied, it's almost intent on ending fossil fuels overnight by forcing companies to invest into new industries, the new called like green economy, but at the same time restricting capital to the industries that the green economy actually relies on. Just to give you a bit of flavor, if you take the electric vehicle industry, for example, it requires enormous amounts of electricity, of materials. It's made out of steel. Steel requires coke and coal. All the plastics, they require oil, requires copper, cobalt, nickel, graphite. You get the point. But the message Shaun said to you earlier, the industry isn't investing enough into these materials. So if you want to have a large-scale rollout of EVs, you're just going to face shortages, and shortages ultimately lead to higher prices. One of the consequences, and it gets quite emotive in the energy industry, but one of the consequences of curtailing capital to the oil and gas sector, for example, is that it leads to higher prices. But the unfortunate thing is high energy prices, higher fuel prices lead to higher natural gas prices, which lead to higher fertilizer prices, ammonia prices, food prices, which is, whether you like it or not, that's just fact. And you can Google that later, but ultimately, if it wasn't for natural gas, half the world's population wouldn't be able to get food due to the importance in the fertilizer production. So at PSG, we take a rational and a different view on ESG, which is also giving us some great opportunities. And one of them being the energy sector, and Shell specifically. I think you all know Shell, but obviously it makes most of its money from oil and natural gas. They've got the largest LNG business in the world. They've also got a large and growing renewables business. What this chart here shows you is the global capital spending by the oil companies going back to 2010. And very similar to the mining industry, you saw this capex boom during the shale boom years. You saw an enormous crash in 2014, 2015, which was arguably worse than in the mining sector. But similar, you saw capital discipline thereafter, paying down debt, returning capital to shareholders. I think we all remember 2 years ago we had negative oil prices. That event ultimately led to Shell having to cut the dividend for the first time since World War II. But the critical difference with the energy industry to the mining industry, aside from coal, is that energy has been in the crosshairs of ESG activists that ultimately is forcing these companies to divest assets, to stop production, and invest behind the energy transition. The reality, though, if you look at the grey bar over here, that's the estimate by the International Energy Agency, the estimate for the capex that's required to meet energy demand or oil demand in 2030. The industry isn't spending enough, and the consequence, once again, is higher prices. So don't get used to petrol prices maybe going down again anytime soon. Our Shell thesis is pretty simple. It is an energy company producing fossil fuels, but also renewables. But it's an energy company in an energy-deficient world, and it's got a leading LNG business that's critical to the transition to a cleaner energy future. But importantly, it's trading at 6 times cash earnings, and it's returning about 11% and probably more of its market cap back to shareholders of our dividends and buybacks. Now, given that backdrop of underinvestment that's pretty clear in this industry, we think those cash flows are sustainable and will grow in future years, making this a very attractive opportunity. Now, putting it all together, the distortions that we're talking about, we think will take years to unwind. And once again, you can't predict the fourth quarter per se. But very importantly, we've got a portfolio that's well diversified. It comprises many different ingredients. Our core ingredient here are our underappreciated quality companies. That's our classic 3M type opportunities. Shaun alluded to some of those earlier. But I'd like to kind of single out the likes of Summer Property Group, which is a US-listed company. It's the largest retail real estate investment trust. It trades at a dividend yield of 7%, which is 4% above the 10-year US government bond. So arguably, it's already priced for recession. But we think the US consumer is robust. You can see this in the recent results. And we think distributions will grow for many years to come. Another example is Prudential, which is one of Southeast Asia's largest life insurance companies. It's got a long runway of growth ahead in future, given the wide coverage gap for underinsured population in Southeast Asia. Currently, the fears are on China, ongoing COVID, unfortunately, and it's UK listed, so it tends to fall through the cracks, but it's extremely cheap. It trades below embedded value. It's very similar to a company like AIA, which football fans will be familiar with, but it's much, much cheaper. The second important component are the real asset companies. We've touched on Glencore and Shell. So those are companies where the supply is very constrained, and dynamics similar to mining and energy are very, very similar in the likes of the shipping companies. Order books are at record lows. So we've got investments in the likes of the tanker companies, dry bulk companies, and also in oil drillers like Noble. And we've got a natural gas company trading at a high free cash flow yield. Another cohort are cheap financial stocks. So those are companies that are trading at low valuations, high dividend yields. Their profits should structurally be benefiting from high interest rates. They're also available in currencies that are currently pretty cheap, like the pound and the Japanese yen. And there I'd like to single out Japan and the UK as good destinations of opportunities, given cheap currencies and a lot of fear in the market. And then last but not least, we've got companies which we call idiosyncratic opportunities. They kind of sing to their own tune. These companies have a bit of a checkered history. They've had a tough few years during COVID, but have clear and credible paths to strong recovery and significant upside potential in share prices at limited downside risk. So yeah, in summary, that's our global positioning. As you can see, it's different to the index, but it's also significantly cheaper than the index at about 10 times earnings. And our holdings, we believe, have significant upside to fair value, which makes us bullish on the opportunity that we have globally. So with that, I'll hand back over to Shaun, and thanks for listening.
Thank you, Philipp. If I could just kind of endorse what Philipp has just said, that we think global is going to be really, really important, and it's taken us time to really come to grips with what a global process and global capability looks like. It's delivered very well into our domestic funds. It's starting to deliver extremely well into our global funds, and if I look 5 to 10 years down the line, I'm really bullish what this can do for PSG in the future. And I think the backdrop is exceptional. What it means in terms of our local funds, and I'm using the PSG Equity Fund as an example here, is that we're finding opportunities in very similar areas on the JSE as we are offshore. We've spoken about those underappreciated defensive growers, companies that we expect to compound profits over long periods of time, that the market is massively underappreciating just how good they are. We've spoken about that specific opportunity in the mid-cap arena. That's bread and butter for PSG. It's over long time periods, it's done very well for our clients. We see no reason why that should be different in the future. We're seeing good opportunity in those supply-constrained real assets. The difference with our funds is we're able to stock pick globally. So if you look in that bucket, you'll see a lot of those names aren't available on the JSE. We've got, the PSG Equity Fund has 7% exposure to the shipping industry. Most of those names, other than Grindrod, are actually accessed offshore. We also have roughly 13% invested in the energy complex. We don't own Sasol. We think there are far better opportunities within energy than Sasol currently. Sasol's got tremendous tailwinds, but they're better opportunities. Philipp spoke about Shell, but we also own drillers, and we own Woodside, and we own BP, et cetera, et cetera. Cheap financial assets. South Africa stands very nicely alongside places like the UK and Japan. We'd be bullish South African banks, but what you will notice is you'll notice a general preference for insurers within PSG portfolios. We think insurers have something special that you don't get via the banks that people are missing at the moment. The question that is being raised a lot is that in the context of the changes to Regulation 28 and the ability for domestic funds to go to 45%, what does that mean for PSG's portfolios? So we're excited. We have this global capability. We have this global track record. So to be able to exploit a wider universe can only be good for our clients in the future. Where we currently are is that most of our funds are at or around 30%. So we're quite a bit under where we could be. The PSG Equity Fund is currently at 30%. Over time, chances are we will get closer to 45%, but we're in absolutely no rush. We are a bottom-up house, and it's going to be based on the individual opportunities that are coming through our process. And because we run a global process, we can compare global ideas to local ideas. And the fact that we haven't used our full exposure means that the local ideas look very rich to us currently. But the other thing I want to add into the mix is this has become quite a hot topic in the financial press lately, and I've seen some of our competitors have rushed, the week after the announcement in the budget, they rushed to go to 45%. We think this is far less of a big deal than meets the eye. And one of the reasons for that is if you actually look into the JSE is not a domestic index. 2/3 of the JSE, and I'm using the top 40 here, but the capped SWIX is going to give you the same outcome. 2/3 is either dual listed, so in other words, they're foreign companies that happen to list locally, or they're out-and-out rand hedge companies. So don't kid yourself that the JSE is a play on SA Inc. So ladies and gentlemen, hopefully our message has landed. Hopefully you've got a sense for why PSG is bullish. We think this is an unbelievable opportunity set. But we think to exploit this opportunity set, you have to be able to think differently. You have to be able to accept some of the volatility that is inevitable in an environment where interest rates are rising and where the global economy is slowing sharply. We do think that those market distortions that we've spoken about will take a long, long time to unwind. When you see such a big difference in valuations and in positioning, it's not going to happen overnight. And like it or not, people follow price performance. So we'll need to see sustained outperformance by things like the energy sector, by value stocks, before people start thinking that maybe having 5% of our money in value is too low. It will take time. We're seeing good opportunities. We're taking a long-term view. We think if we look into the specifics of those opportunities, we see very limited downside and we see lots of healthy upside. So that speaks to why pretty much all of the PSG funds are offensively positioned. We have low levels of cash in our funds and we think good things lie ahead. So I'd like to thank you for attending. I wish everyone well, and yeah, thanks again. Thanks from PSG's side.